right, now let's look at the future of business financing in Africa. For years, much of the global narrative around African entrepreneurship centered on venture capital, billion-dollar valuations and high-growth technology startups. But today, the conversation is evolving across the continent. Investors and business leaders are increasingly recognizing the importance of financing, what many call the real economy. Businesses operating in critical sectors like agriculture, energy, manufacturing, mobility, logistics, and essential services. These are the companies solving structural problems, creating jobs at scale, strengthening supply chains, and driving long-term economic transformation across Africa. At the same time, we're seeing a major shift in how these businesses are funded. Debt financing, catalytic capital, blended finance, and local currency investments are becoming increasingly important as founders seek sustainable growth without excessive dilution. Well, joining me for this conversation now, we have Oyin Solebo, as the CEO of Cascador. Joining me via Zoom. Great to have you on the show. Good morning.
Good morning, Adi. Thank you for having me.
So, for years now, venture capital, that dominated conversations around, African startups. Why are we now seeing a growing shift towards alternative financing models like, debt, catalytic capital?
Thank you so much for the question, and you summed it up absolutely correctly. So we saw, for example, last year, 1.6 billion in debt funding coming into Africa's startup ecosystem, and it accounted for about 40% of capital. And in the first quarter of this year, we've seen something incredible happen where debt funding has actually overtaken equity funding. Now, to understand, I guess, why that has happened, we have to step back a little bit and take a look at what's happened in the recent years. So in 2022, as you've covered a number of times, we saw this uptick in equity and venture capital coming into the ecosystem because of global low interest rates and investors really looking for a return. But then off the back of geopolitical crisis, we saw global interest rates increase and we saw a lot of investors leave the ecosystem. But companies still need to be funded. So one of the first things that happened is that debt stepped in to fill that gap. But what's interesting is that it was not a crisis move. What we actually saw was that the companies that they were funding were credible companies, mature companies, companies with real revenue, real assets, real customers, companies like Move and Max and M-Copper, who really had earned their stripes and earned the ability to repay debt funding. We then also saw a change in the sources of the capital. So a lot of the big venture funds who are used to investing equity left the ecosystem. And in their place, we saw DFIs, so development finance institutions, or sovereign-linked banks come in and deploy more capital. And these are institutions that are more used to debt funding and therefore structurally more enabled to provide debt funding. And then as all of that was happening, I think we also saw founders ask themselves, do I need to continue pushing for equity funding, or is there something else on offer to me? And what we saw with companies that had been resilient and done well to really succeed through the 2023-2024 funding crisis, who are now more sustainable, more capital efficient, more focused on unit economics, they were able to ask themselves, why should I give up a part of my company through equity funding if I can actually sustain debt funding? So all of these things, I think, have contributed to what we have now seen, where in the first quarter of this year, debt funding actually overtook equity funding.
Right, and it was mostly about, equity funding, before now, but some have argued, for stronger support for, the real economy ventures. What exactly defines a real economy business, in the African context?
Absolutely, and Laddie, I think you summed it up actually really well before I came on. So when we're talking real economy businesses, we are talking businesses that are producing or moving or enabling tangible goods and services that people actually need in their day-to-day lives. So we are thinking agriculture, food processing, energy, healthcare, manufacturing, logistics. These are things that we can really touch and feel. And that is versus perhaps the digital economy, where we're thinking apps, digital infrastructure, marketplaces. Now, both of these have enormous value, but as you quite rightly said, I think it really is in this real economy where products and services are being provided that people need in their day-to-day lives. And regardless of whether or not we have upticks or downticks in the economy, people will still go out and buy these products and services.
All right, so definitely debt financing, that's gaining momentum across the continent. But, you know, when you take a debt, when you take loans, you definitely have to pay back. Do you think some of these founders, do you think debt is what they need right now, seeing that cost of borrowing is really expensive?
Yeah, it's a great question. So I think we have to look at what stage the company is at and then make sure that the type of instrument that they're getting is appropriate. So if you were an early stage company where you were still proving that a customer is able to sustainably pay for your product or service and that your unit economics make sense, that really is where equity should be playing a part. Equity is built to take on that kind of risk. Debt funding is not for that kind of business because, as you said, there is an interest rate that they need to pay, particularly if it's commercial debt funding, so funding from a bank. A very early stage company may not be equipped to pay that back. In fact, it will give put an unnecessary pressure on that company. So I think we really need to look at the stage of the company. But what we are seeing at the moment is that companies are maturing. So again, if we look at the kind of the companies that have gotten the debt funding in recent years, these are companies that have been around for many years, that have shown that they have sustainable revenues, that have shown that they have healthy cash flows, and they have demonstrated that they are able to pay back that debt. That may not be the same situation for a very early stage company where equity really plays a very important role.
Right, and definitely I know you're investing, you know, most of these companies. Where are you stashing cash now?
Stashing cash. So I work for a company called Cascada. I'm the COO there. And at Cascada, we specifically invest in companies who are approaching that growth stage. So these are companies that have proven that they have real revenues, real customers, etc. But probably they are too big for early stage funding, grant funding. And the risk may be perceived as too high for them to get that commercial funding. But these are companies that are filling a really, really important role. They are in that messy middle where they really need the support to get to that growth stage where they can afford growth capital, commercial capital. That is where I'm investing. I think these companies are incredibly important because they are the companies that tomorrow will continue to provide us with the essential products and services that we need. But they are also the companies that tomorrow will be employing massive amounts of people, and particularly, if we talk about the real economy, people in rural areas, low-income communities, young people who may not be as educated as they otherwise would be, and employing these individuals and providing thriving employment opportunities for them. All of that ripples down into the health of our economy. If you think about it, we have, for example, recently invested in an agriculture company called Agriarch. We deployed 2.5 billion naira into that company. That company is helping local and global food processors reliably source commodities from Nigeria and beyond. Now, that is a company that is not only providing essential produce to Nigeria and also to the world, but it is also a company that, through its scale, is able to employ and give decent incomes to everybody that it touches. So those are the kind of companies that I'm stashing my cash into. It's really companies that are approaching the growth stage who, through getting that, that leg up, they can, in the future, afford more commercial capital.
Right, and I'm happy you mentioned Naira. There for that money you're investing there, because I'm seeing most of the founders now, they're looking to take some of that debt in Naira and not, foreign currency, because of the risk there. Thank you so much for joining us this morning. Oyin Solebo is the COO of Cascada. Thank you so much for coming on today.
Thank you for having me.